On February 1st, 2023, a Morgan Stanley research note landed in institutional inboxes with an unremarkable title: Automation and the Future of Labor Productivity. Most people skimmed the executive summary and moved on. But on page 11, between two footnotes, one analyst wrote a phrase that should have caused a room to go quiet. Headcount reduction is now the primary lever for margin expansion. Asterisk. Not efficiency. Not optimization. Headcount reduction. The layoff wasn't a side effect. It was the strategy. And that morning, the stock went up 4%. Nobody on the earnings call asked the question that phrase made unavoidable. Not one analyst. Not one journalist. The question was simple. If the machine does all the work, who's left to buy what it produces? Asterisk. That silence is where this investigation begins. Because the answer isn't theoretical. It's in the productivity data going back to the 1920s. It's in a specific appendix of a 2019 IMF working paper that almost no one finished reading. It's in the USDA agricultural census from 1930. Columns of bureaucratic numbers that document, without drama, the moment a productivity miracle curdled into a demand collapse. The paper trail was always there. This is what it says. Pull up the 10K filings from Amazon, Microsoft, Google, IBM, Salesforce, any major firm that employs large numbers of knowledge workers and has spent the last 3 years integrating large language models into its operations. In each filing, find this phrase, AI-driven productivity improvements. It's there. Now scroll one row down to the headcount column. In the 12 months following GPT-4's public release, the technology sector cut roughly 260. 0 jobs. That's every programmer, analyst, and legal researcher in a city the size of Orlando gone in 12 months. Not factory workers, not warehouse staff, the cognitive workers, the ones every displaced factory worker was told to retrain and become. But one filing stood out. Not because of what it said, because of what appeared on the same page as its layoff announcement, buried in a single footnote, adjacent to a headcount reduction of 12,000 roles, was a disclosure of record operating margins, the highest in 7 years. Rising productivity, rising profit, falling headcount. In macroeconomics, this combination has a name: jobless recovery. But the name smooths over the mechanism. Productivity gains don't evaporate. They go somewhere. And in every reporting quarter since 2022, they have gone overwhelmingly to shareholders, not to the workers whose roles the algorithms absorb. That's not a moral judgment. It's an accounting entry. And it sets up the central problem this investigation is actually about. On January 5th, 1914, Henry Ford announced he would pay his assembly line workers $5 a day, more than double the industry standard. The press called it charity. His accountants reportedly pushed back. Ford, in his memoir, was blunt about the logic. If we can distribute high wages, then that money is going to be spent. It will be used to buy and pay for the goods our factories produce. Asterisk. He wasn't being generous. He was closing a loop. The paycheck and the purchase order were two entries in the same ledger. That loop held for most of the 20th century. Employment generated income. Income generated spending. Spending justified production, which required employment. Self-reinforcing. It underpinned the largest expansion of middle-class wealth in recorded history. Now isolate the moment that loop begins to separate. Not dramatically, not all at once. Productivity climbing. Wage growth flattening. The gap between what the economy produces and what workers can afford to buy widening. Quarter by quarter. The Bureau of Labor Statistics has been documenting this for 20 years. Between 2000 and 2020, median real wage growth for college-educated cognitive workers averaged roughly 0.5% per year, compounded over 2 decades. That's approximately $8,000 in cumulative real income gains, less than the cost of 1 semester at the university they were told to attend to get that job. Meanwhile, annual tuition at four-year universities increased by roughly $1, $400 per year across the same period. The math never worked. And now look at the BLS data from 2022. There is one column in that data set that breaks the pattern entirely, and it's the column nobody cited in any of the press releases. That column is the next chapter. In October 2019, the IMF published a 47-page working paper, The Future of Work, Managing the Digital Transformation. The executive summary was confident. The policy recommendations were measured. Several newspapers quoted the abstract. Almost nobody read Appendix C. Appendix C modeled the distributional outcomes of 3 AI adoption scenarios across OECD economies. In the first two, partial automation, augmentation-led adoption, the models showed disruption, but eventual re-equilibration. New job categories absorbed displaced workers within 10 to 15 years. Purchasing power recovered. The third scenario, labeled accelerated substitution, produced a different result. The authors modeled a displacement to absorption ratio of 2 to 1. For context, the worst ratio recorded during the 2008 financial crisis was 4 to 1. They buried that number in Appendix C. In the accelerated substitution scenario, displacement of cognitive labor outpaced the creation of new labor categories by a margin the authors described as historically unprecedented. The result wasn't unemployment in the traditional sense. It was a structural narrowing of the consumer base. Fewer people with enough discretionary income to sustain the demand levels that production capacity assumed. In one understated sentence, the authors noted that the closest historical analog was the United States between 1927 and 1932. That sentence deserved more than a footnote. Here is exactly why. Between 1910 and 1930, American agricultural productivity roughly doubled. The gasoline tractor, the mechanical harvester, improved fertilizer chemistry. Output per farm worker increased by approximately 30%. The USDA agricultural census from 1930 recorded the consequence in dry columns of numbers. Farm employment collapsed. Between 1920 and 1930, more than 1 million agricultural workers left farm labor not by choice, but because the tractor made them redundant faster than the industrial economy could absorb them. In the street, Louis Fed Archive. There is a memo dated March 1931. A Federal Reserve official, reviewing internal consumption data, wrote in the margin by hand, "Demand is present, but income is not." Asterisk. 4 words, buried in a working memo. The clearest description of what was happening, and it sat in an archive for decades. Those displaced farm workers had moved to cities. They were looking for factory work. They arrived with reduced savings, reduced purchasing power, reduced economic security right at the moment the industrial economy needed consumer demand to sustain itself. When the financial system cracked in October 1929, it didn't cause the depression by itself. It triggered a demand collapse that was already structurally loaded. The Federal Reserve's own declassified memoranda from 1930 and 1931 document officials struggling to understand why monetary easing wasn't restarting consumption. The answer was in their own data. The consumers who needed to spend didn't have the income to do it. The productivity miracle and the consumer economy had run directly into each other. Neither had a mechanism for resolving the collision. Now look at what's in this quarter's filings. In Q3 2023, an analyst on Amazon's earnings call asked about the impact of warehouse automation on unit economics. The CFO answered with precision: lower cost per unit shipped, improved margin, better returns on invested capital. No one asked the follow-up. The follow-up was this: Amazon's largest customer segment, the middle-income consumer, overlaps almost exactly with the demographic being displaced by the automation programs Amazon and its peers are running simultaneously. The question that wasn't asked is whether those two facts appear in the same model anywhere. They don't. And that absence is the specific irony at the center of this investigation. When Amazon automates its fulfillment centers, it improves its unit economics. When every major retailer does this simultaneously, it reduces the aggregate wage income of the demographic most likely to buy from every major retailer. This has a precise name in economic theory: the fallacy of composition. What is rational for one firm becomes destructive when every firm executes it at once. A single factory replacing workers with machines reduces its costs. Every factory doing it simultaneously reduces its customers. In March 2024, a Goldman Sachs internal research note, later quoted in the Financial Times, estimated that AI could automate tasks currently performed by the equivalent of 300 million full-time workers globally. The same note projected significant GDP gains for early adopting companies. It did not model what happens to those companies' revenue when 300 million workers have less money to spend. That is not an oversight. It is a structural blind spot that every quarterly reporting cycle makes worse. The incentive is to optimize for this quarter's margins. The consequence lands in someone else's quarter or someone else's decade. Economists modeling this transition tend to converge on three paths. Each has a documented historical analog. None are comfortable to look at directly. The first, the transition works. New categories of labor absorb displaced cognitive workers. AI becomes an amplifier, not a replacement. Inequality rises in the short run, then stabilizes. This scenario has the weight of every previous technological revolution behind it. The problem is the timeline. The textile revolution unfolded over 70 years. The agricultural to industrial shift took a century. AI is operating on a timeline measured in software release cycles. The second, the transition works, but only at the top. Workers who successfully integrate with AI systems command significant premiums. Everyone else falls into a bifurcated labor market: high skill, high wage work above, low skill, hard to automate service work below. The purchasing power dense middle, the demographic that has sustained consumer economies since Ford closed his loop in 1914, contracts. Some economists argue this isn't a prediction. It's a description of what the wage data since 2000 already shows. The third, the transition fails at the system level. The gap between productive capacity and consumer purchasing power widens until it becomes a demand crisis. The 1930s scenario, the one no one puts in an executive summary, even when it appears in Appendix C of their own working paper. There are proposed mechanisms for preventing the third scenario: universal basic income, profit-sharing mandates, sovereign wealth funds invested in AI infrastructure on behalf of citizens, shorter working weeks to distribute remaining labor more broadly. But here is the specific detail that closes the paper trail. The companies most vocally opposed to universal basic income legislation documented in their federal lobbying disclosures are, in several cases, the same companies whose automation programs have most directly accelerated the labor displacement that UBI is designed to address. The same 10K that logs the productivity gain from headcount reduction also logs the lobbying expenditure against the policy that would sustain the customer base the headcount reduction is eroding. Both entries are in the same filing. Almost nobody reads them on the same page. The Morgan Stanley analyst who wrote that phrase on page 11, headcount reduction, is now the primary lever for margin expansion. Did they know what they were describing? Did anyone on the desk that morning? The paper trail doesn't answer that. What it does say is this: the same logic was present in the USDA census columns from 1930, in the Federal Reserve memo with the handwritten margin note from 1931, in the IMF's Appendix C that almost no one read in 2019. The mechanism has been documented at every stage. The warnings surfaced. They were noted, filed, and superseded by the next quarter's reporting deadline. Henry Ford understood in 1914 that the paycheck and the purchase order were two entries in the same ledger. The question this investigation leaves open, the one no earnings call has yet been asked to answer, is whether that loop can be deliberately reclosed before the data forces it closed on its own terms. The paper trail already shows what happens when the answer is no. The only question is whether anyone reads past the executive summary this time.